Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat for our guest today is banking on financials the right bet under the current context? Is IT in for a bit of a turnaround? Because his bets seem to suggest that they are bracing for some bit of an uptick in IT relative outperformance relative to the past. Have aerospace and defense and some of the sectors which have run so well in the recent past finally run their course, or could there be more? And of course, because he looks at macro with as much keenness as micro, we cannot let Mihir Vora go, or we cannot start a conversation with Mihir Vora without talking about the global macro. He joins in on the show today. Mihir, thanks so much for joining in. I was really hoping that we do it in person, but maybe some other time. I understand you had to go to your office today, but yeah, some other time in person from our studios. But thank you for taking the time out, Mihir. And just such a perfect day to get you. We've seen the non-farm payroll data come out. And the interesting thing is that maybe earlier the market wanted weak data to lead to some heavy central banking action for the markets to do well. Now the market seems to be worrying that yes, there will be central banking action, but growth seems to be a problem, and therefore there is a worry out there too. How do you look at this curious set of events?
Good morning, Neeraj. Thanks for having me. Always a pleasure to be on your show. So market always wants Goldilocks, right? But you may not get Goldilocks all the time. So market wants the US economy to slow down just enough so that there is a justification for rate cuts, but not too much that it goes into a recession or something like that. So that's something that you know is wishful thinking. My base case is that the US continues to slow down because if you look at the overall macro picture in the US, the excess savings of the households has actually been depleted. The excess savings that we saw because of the COVID stimulus, that is depleted. So you can't continue to expect the same kind of traction in retail sales, services, etc., that we have seen in the last 2-3 years. And you know, the farm rolls data and the other data points in the last few days that we have seen, especially on the job creation side, there is a distinct sign of slowdown. So I think my base case is that the US continues to slow down as far as the retail consumption, etc., is concerned. So you may see some downgrades on that space. On the flip side, that may not immediately lead to technology spending because corporates have still made a lot of money. You are seeing earnings resilience in the tech sector, at least so far. So you may not see the immediate impact for Indian IT services, but for the global economy, as far as commodities are concerned, as far as general goods and services trades is concerned, you can see some slowdown.
Got it. Okay. So Mihir, there is a slew of central banking decisions. I think we have ECB this week and the Fed may be following some of the European central banks. Based on your base case of the US continuing to slow down, but we're also looking at Fed action, even if it's just 25 bips or 25 basis points in the current policy, but maybe some more in the times to come. What is your stance on risk assets in general? We'll come to India valuation specifically, but I remember you telling me that central banks have been the driving force behind market moves ever since COVID lows. Does that continue to be the case, or would you be skeptical on risk assets?
I would be a little circumspect, but not necessarily for, say, flows to emerging markets, because what the banks are trying to do is make sure that the dollar does not appreciate too much or depreciate too much. But if the pace of rate cuts in the US is faster than the rest of the world, then you might see a gradual depreciation of the dollar against the major currencies, which can lead to a little bit of positivity for the risk assets. But my observation over the years is that ultimately it's growth that matters. And if the rate cuts are happening in a slowdown cycle, then it does not necessarily have a salutary impact on risk flows. I think the fundamental requirement is growth, and if growth is slowing down, then you can see some volatility and some uncertainty for sure.
Got it. Now, just trying to figure out what happens sectorially, and I'll come to individual themes or individual ideas in a bit, because I see some of the changes that you presumably have made to your portfolios too. So I would have some questions there. But before that, is it a turn for some of the lesser performing names which are trading at better valuations to make a bit of a comeback cyclically, and for some of the ones which have done really well in the last 12 to 18 months to take a bit of a breather or maybe even correct? Could there be a barbell strategy of sorts?
So I think the base thesis and the themes would remain the same. We've discussed this in the past that we are more bullish on the domestic economy compared to the rest of the world. So that base case remains. Within that, we are still of the view that the financialization of savings and premium consumption will structurally continue to do better. And a physical asset creation, which includes infrastructure, manufacturing, real estate, will continue to be the focus area for the markets. The other one is, of course, that new business models will continue to get evolved. We'll see a lot more companies with these new age, new tech companies, which will be an interesting space to watch out for. So these 3-4 themes, I think nothing has changed in the last 4-5 months. That for us that remains. Within that, what has happened is that while say 1 year ago, 2 years ago, some of the manufacturing themes, defense, etc., even railways themes were relatively unknown and under-owned in the institutional portfolios. So of course they had a dream run. We saw many multi-baggers in that space. But now I think we probably overshot a little bit, and typically when you have too many thematic funds in a particular segment coming in, it means that the sector is now well discovered. So to that extent, the last 4-5 months, we have seen a slew of funds in this physical asset creation space, manufacturing, defense, etc. And stocks, of course, did run up and make a peak. So I think for the time being, while we are very, very bullish on these segments in the medium term for 3 to 5 year view, probably stocks had overshot and there's a bit of a correction. So in the last couple of months, we have reduced allocation purely based on valuations. I don't see too much of a threat to earnings. But purely because of valuations overshoot, we have reduced space in some of these segments. Over the last 2-3 months, what has also happened is that we are incrementally seeing some positive commentary from the companies which deal in the rural markets. So it's not like all gangbusters and things doing very well. But if you look at some of the data points like apparel consumption in tier 2, tier 3, tier 4 towns, commentary from some of the FMCG companies, there is a feeling that probably the worst of the slowdown in the rural consumption is probably past us, and on a good base with a good monsoon, we should start seeing some pickup. So rural consumption was something that we were negative on, but probably we are getting incrementally more positive, and we've kind of added a little bit of exposure in this theme. So that's one thing to look for. I think rural versus urban consumption-wise, rural incrementally may do a bit better. Urban still is a mixed bag. Cars are not doing that well. Rural two-wheelers, which are rural, they are doing well. So I think rural versus urban, rural is beginning to look a little bit better. The other big one actually is financials, where we do see a theme where the market is expecting rate cuts. But the impact of rate cuts will not be uniform in the short term. So to that extent, the markets are kind of rewarding lenders which have a predominantly fixed rate book, and that happens to be typically in the NBFCs. So within lenders and non-lenders, so on lenders we have banks and NBFCs. Non-lenders we have a host of companies in the capital markets, insurance, wealth management, broking, asset management space. So that's the non-lenders. So we are more positive on non-lenders to start with because it fits in with the financialization of savings theme for us, so we are more bullish there. And within lenders, within bank and NBFCs, at least for the medium term, not medium term, I would say short term, we are a little more positive on the NBFCs because a lot of the NBFCs have a fixed rate book, and when interest rates come, the liabilities will get repriced downwards, and immediately assets will take a little bit of time. For the banks, most of the book is floating rate, so the assets will get repriced faster. So you might see a little bit of compression for the short term for banks. So tactically, I would be more positive on the NBFCs within the lending space.
Okay. So, well, viewers, that's the whole gamut of things. I want to start off, though. I'll talk about defense in a bit. I want to start off with the global facing sectors, IT, and to an extent, pharma. Now, Mihir, I heard you say that you believe more in the domestic themes and less on the global facing themes. But I do see, and correct me if I'm wrong, but relative to June, in July, your exposure to IT has increased from what, sub 6% to maybe around 9%. Is that true? And if so,
Okay.
why is that a bet when you are more focused or more constructive on domestic?
Sure. So that's more of asset allocation based on the profit booking that we did in some of the cyclicals that I mentioned. So, for example, while we continue to be very positive on defense, infrastructure, manufacturing, etc., we had a huge exposure to that segment, which we have trimmed dramatically. We almost had 20+% exposure, which we have in the last couple of months trimmed down to about 10%. So that the reallocation of that 10-12% that we do, some of it obviously went to IT where we were significantly underweight. So you can say we're not like very positive on IT, but we've significantly reduced the underweight position that we had.
Okay, but you're not too constructive on IT. This is just a reduction. Okay, what about? And before I come to pharma, what about within IT pack, Mihir? IT services, ER&D, and we have some of the tech plays which are more domestic focused, and we've seen the kind of gains that the Zomato, PB Fintech, now even a Paytm is reviving, etc. And then there's some of the others too. Within this bucket, and I'm presuming that even the domestic tech plays form a part of this 9%, correct me if I'm wrong again, where is it that you are more constructive on within these buckets?
So I don't really treat these new business model companies as IT per se, because they are more consumer companies in my view, because they face the consumer and use technology, of course, to reach the consumer. But for me, they are more of consumer companies. So we are very constructive. That's one of the things that we are definitely playing on, this new business models. So that's a definite plus for us, yes for us, overweight. Within IT services, I would say it's a stock pickers market, but in general, if I were to look at the top 4-5 companies, we are talking about at best single-digit kind of growth. My view on the large companies is large IT services companies is that we will revert back to pre-2019 growth rates, which is again single digits for the medium term. The spike that we saw because of COVID spending on IT by US corporates is past us. So on that base, I don't think they've not. Let's face it, they've not tweaked the business models dramatically to give us the confidence that they are going to grow faster than what they did in the past. So to that extent, it will be a good, predictable, medium growth, medium expectations kind of sector. But if you expect the Indian economy to outperform the rest of the world, then you probably don't want to be very overweight on the large IT companies. In the mid and small cap IT space, IT services space, there are companies which have different target segments, as you mentioned, ER&D. There are companies which focus more on BFSI. So my guess is that you might see some more attraction on the BFSI spending space in the US after a long time. AI probably will give some opportunities for some of those companies. So I would say that IT will more for us be a stock pickers market, where we would like to pick stocks in the mid-cap space rather than go very over on the large IT companies.
Got it. Now, pharma is in focus. Before I go to Mihir on his thoughts on pharmaceuticals, there are some news announcements that have come in today. It would be good to get in my colleague Varsha to give us a lowdown of what have been the latest developments and what are the stocks that are moving as a result of that. Varsha, good morning.
Good morning, Neeraj. So, few of the pharma stocks are actually under pressure. Now, let's start with Lupin, wherein Lupin is facing a legal challenge related to its generic version of the drug, which is used to treat kidney problems. Now, the original maker of this drug, which is Otsuka, is challenging a recent court verdict that favored Lupin's generic version of the drug, and the Lupin was expected to launch this product in April 2025. However, this new appeal introduces uncertainty whether Lupin will be able to launch this product or not. Now, the primary product for the innovator is contributing almost $1.5 billion of revenue for the company. So that's the market that Lupin was actually targeting. Let's see what Citi has to say. So Citi has a sell rating for the stock with a target price of 1700, implying almost 24% of the downside. Citi says that Lupin may choose to delay the launch of this generic drug, and the company may not capture as much as market compared to a typical launch that was expected. And this will actually impact significantly to the Lupin's financial numbers, as Citi was expecting a 30% contribution from this product in FY26. And then we have Granules India, wherein they've got 6 observations from US FDA for their Hyderabad plant. The inspection was from August 26 to September 6, and this facility is actually crucial for Granules and contributes. So major contribution comes from this facility and is crucial for manufacturing finished doses and the intermediate products, and it also supports global operation for the company. We don't have the revenue contribution, but we do have the capacity. It has a capacity of almost 23,200 tons for intermediates and 26 billion units for their finished doses. Then we have Suven Pharmaceuticals, wherein US FDA conducted inspection for their subsidiary plant, and which was categorized as VAI, that is voluntary action indicated. That means that US FDA has found some lapses, but those were not severe enough to take any kind of action, and the company is therefore expected to take the voluntary actions for these regulatory approvals.
Thanks a lot for that, Varsha. Mihir, pharmaceuticals, the price action seems to suggest that there is a bit of flow into some of the specific pockets. But the US generic makers have already had a rally in 2023 too. Are you constructive here, or are you part constructive? Would love to know.
Pharmaceuticals, we are constructive now compared to say 4 months ago. Couple of things. Structurally, the sector did go through its ups and downs in the last 4-5 years. But I think the worst of the generic pricing pressures are most likely past us. So that's one good thing for the generics companies. But I think post-COVID, what has also happened is that a lot of companies are now looking for the CDMO opportunity for India, the CRO opportunity for India, because like it or not, people have realized that we need to, for the sake of security, diversify away from China. And China is really big on CDMO. So I think apart from the generic opportunity, the CDMO opportunities have also opened up for Indian pharma companies. And that's the reason why we do think that in the next 3 to 5 years, this sector should do quite well. The good thing about the sector is that you also have companies with a predominantly domestic exposure. So there's a wide basket to choose from. You can choose companies which are more like FMCG companies because they do the local markets. You can choose the generic companies, or you can choose companies which are in the research and CDMO space. So there's a whole gamut of companies to choose from, which makes it a interesting sector.
Okay, and watch out. So again, because it may be a very bottom-up theme here in pharma, but also from sectorally divvied up, right? Healthcare very divvied up. CDMO, as you said, or pure pharma, or even other facets of healthcare. Is there a first amongst equals there? Is there a theme within pharmaceutical that you like more versus some of the others?
Sure. So if you look at the incremental target markets which are opening up, I would say it's the CRO and the CDMO space, because that's something that not many Indian companies were focusing on, and this is something that's opened up in the last 2-3 years because the multinational companies are actively looking to source from India. So that's one space where we can see incremental action.
Okay. Remember, viewers, by the way, me, just one quick follow-up there. I don't want to make this entirely pharma discussion. One last question on China, but one quick question. There's a lot of talk of the Biosecure Act being passed in the US this week and the impact that it could have on CRO, CDMO. Is that something which is very big, or is it something that is difficult to analyze right now?
No, it is a significant. It's a significant move. You may not see the impact of it in the top lines of companies for 1-2 years, but structurally it will open up a whole new, opportunity. The target market incrementally can be quite large. Got it.
So significant, viewers, but not immediately. Now, Mihir, one final word, and I started with macro. I'm ending with macro. The only difference is I started off with the Fed and central banks, and I'm ending with China. You look at these correlations very, very closely. I would love to know, China deflating the way it is and the impact that it has on growth globally because it's such a large portion of the global economy, and the impact that it has on commodities per se as well, because it's such a huge guzzler of commodities until it started deflating. What is the slightly medium-term impact that you foresee if China continues to deflate the way it is currently?
Specifically for commodities, you are asking?
In general and in commodities both. I would love to pick your brains on everything that you think about when you think of China.
Sure. So first of all, I don't believe that China GDP growth is going to come back for a long period of time, just because they have peaked out in terms of working age population 4 years ago. Second is they have also created all the infrastructure and real estate that they need. So there is a huge oversupply of infrastructure. There is a huge oversupply of real estate in China, and both these of course are huge guzzlers of commodities. So it's not a very good scenario for Chinese consumption of commodities, and China happens to be half the market or 70-80% of the market in certain commodities globally. So I think commodity price inflation is not going to come back in a hurry. That's my base case. The other risk that you rightly pointed out is that because China needs to keep supporting its growth, and if you can't build more infra, if you can't build more real estate, what do? So they are ramping up manufacturing, and they are ramping up manufacturing not only on the commodity plays like say your luggage and toys and stuff like that, but they are actually going high tech also. So that I think in terms of deflation will continue structurally, and you will see China becoming more dominant. The hope is that, of course, in companies like India, Vietnam, etc., will come up as alternate manufacturing base to China. But China is not going to let that go easily, because they also need to keep growing. So it's going to be a race, and while we are very positive on Indian manufacturing, etc., it's not like it's going to fall in our laps without us doing anything. We really have to work hard towards it.
So therefore, okay, just final quick 30 seconds or 60 seconds. If China does expand its manufacturing capacities the way it did in the past, or maybe more than that, and even if there are duties, if goods which are cheaper land in neighboring countries in a much lower cost, then it has an impact on product price inflation for manufactured products even in India, right? Even if there are duties on Chinese imports. Does that therefore make the attractiveness of the Make in India story slightly lower?
See, we'll have to be smart about it, and I think the government also realizes it. So you have, for example, of course, duty is there. We'll have to be smarter about the free trade agreements that we are signing. For example, you can't, let other countries act as a conduit. And third is that there are non-tariff barriers that also what we have seen from time to time that the government use, like BIS hallmarking, etc., which kind of is not, which makes it a bit difficult for Chinese companies to import, etc. So I think there is awareness within the system, and PLI is another way of countering it. So on one hand you have tariffs, and on the other hand you have kind of PLI incentives for manufacturing, which makes it cheaper. So I think we are trying to go about it, from all sides, and we are seeing good progress. At least the last 2, 3, 4 years have been very heartening in terms of electronics and a lot of other sector. But as I said, you can't be sleeping at the wheel. We'll have to be continuously vigilant and proactive.
Got it. Mihir Vora, such a pleasure talking to you. Thanks so much for taking the time out and being with us, and look forward to talking to you in person soon.
Absolutely. Thank you so much.
All right. That's Mihir Vora of Trust MF. With that, it's a wrap on this leg of Talking Point. Thanks so much for tuning in.